Hi, and welcome back to the Intentional Wealth Update for the week of September 20th, 2021 from Morton Brown Family Wealth. I'm Dennis Morton here with Cody Demmel. Cody, how are you doing?
Good, how are you?
Great. So we are looking like September is going to be the first down month that we've experienced in 2021 for the stock market. We've had a lot of volatility recently, had a pretty big down day, the first day of the week this week. Investors are pretty pessimistic. You found an article talking about just how pessimistic they are, right, Cody?
Yeah, so CNBC put out an article today that went over the results from a survey of around 400 different chief investment officers, equity analysts, and portfolio managers that they conducted this week. So they asked two questions in the survey. The first was, what kind of market risk are you willing to accept right now? And they only gave them two options. The one option was very conservative at this point or very aggressive. And then the second question they asked is, what are your expectations for the S&P over the next 12 months? In that question, they gave them three different options: up over 5%, flat to up 5%, or negative over the next 12 months.
Okay, so how's everyone feeling? Where did the weight come down on the optimism versus pessimism?
Yeah, so the first question that asked what kind of risk they're willing to take right now, 75% of them said they would rather be very conservative than very aggressive at this point.
It's 3/4. Wow. But then when we looked out further to say, all right, what are the returns going to be? What did they say?
Yeah, so then the second question that went over what their expectations were over the next 12 months, over 50% of them said that they think the S&P will return over 5%. And only 5% of them said that they expected it to be negative over the next 12 months.
All right. So our takeaway from this is all very short-termism. I mean, they're asking people like, how are you feeling right now in this minute? And that's kind of an interesting distinction. They're not talking to you and I as advisors. They're not talking to investors who have long time horizons and financial goals. They're talking to money managers and people who are measured on short-term performance. They can get fired if they don't get it right. So they need to kind of come down on these things, right?
Yeah, exactly. So the people they're asking are chief investment officers, equity analysts, and portfolio managers who, as you said, are being evaluated on their short-term performance over the year. So right now, when we do have a little bit of volatility, obviously they're feeling a little bit of pessimistic. So that's right. I don't think it's really surprising, but it was good to see that over half of them still have a good outlook over the next 12 months.
Right. And this got us talking this morning about, and really the theme for today is corrections in the stock market. And what is a correction? Because it's a term that we throw out there. It's a part of our normal language that gets turned into something financial. A correction is actually something that's a pretty natural event. And we get the question, is the market going to have a correction? Yeah, it probably is. So Cody, what is a stock market correction?
Yeah, so the definition of a correction is the stock market being down between 10 and 20%. So if it goes down below 20%, that's when it drops down into what's called a bear market. So a correction is a drop in the stock market or a specific index of around 10%.
Okay. And when we say correction, so we're not talking crash of 1987. We're not talking the pandemic of 2020. We're talking that 10 to 20% range. How frequently are those happening?
I think we read it earlier this year, but it happened, 53 times since 1926?
Since pretty frequent. Yeah, pretty frequent. Ben Carlson had an article on volatility earlier this week, and he talked about every four and a half years is a decline of 20% or more. And there have been 53 double-digit drawdowns over that period. And here's the thing, Cody, why don't you pull up that chart of just the last 10 years, just to put the pullback that we've had recently into some perspective. This is a chart of the S&P 500 total returns for the last 10 years. And as you can see on the right, it's up 352%. And I went back and looked to see just kind of what happened over that 10-year time period. And a lot of it's going to sound really familiar. Since 2012, we had the fiscal cliff and debt ceiling crisis of 2012. We had the Fed threatening to raise rates and then increasing rates. We had the Ebola virus, 2 government shutdowns, Brexit, 2 contentious elections. The Dow fell 1,000 points and then fell it again and again and again. We had a 20-month period where stocks went nowhere, a 20% decline at the end of 2018, and a global pandemic in its 18th month. And we were still up 352%. Isn't that crazy? I think that the lesson here is that anytime the market's feeling frothy or we've had some steady returns, and you look at that line up until September, that line had been pretty steady going back about a year, steady upward trend. we start to think of which event's going to upset it. It doesn't need to be, it doesn't need to be prescribed. A lot bad things can happen along the way, and you can see that choppiness in the markets. But a correction does not mean the end of your investment strategy. Okay. All right, so Cody, we have this other chart.
So this chart is year to date. The percentage the S&P 500 is off its all-time high. So we can see at the lowest point, which actually happened earlier this week, it was down almost 4% from its high. Every other time this happened so far this year, it just got bought up really quickly back to all-time highs. And I think one thing to point out, and I know we've gone over this a lot, but the average intra-year decline of the S&P 500 in a year is almost 14%. Not saying that's going to happen this year, but the fact that we, at the lowest point this year, we're only off 4% from the high, it does feel obviously choppy, and you can see the choppiness here, but the drop we've had is not large at all.
Yeah, this is kind of a really short time frame. It's just less than a year. But there are periods of time where you can go a while where you're not getting rewarded for taking that risk. We had a period from 2016 to the beginning of 2018, the market went nowhere, just kind of bounced around, kind of rolled over a few times. But then you get rewarded in these short spurts. That's exactly this. You talk about if you got out at the wrong time, if you thought things might go lower and you missed that zip back, it's hard to make up for that ground. Going back to the Ben Carlson article, he talks about how from 1940 to 1968, there wasn't a single bear market in excess of 30% down. And then over the next 6 years, it happened twice. And it happened in such lumpy stages. That's why it's really hard to kind of extrapolate what's happening today and say, is this going to be a bear market? Is this going to be a correction? We don't know, but that's where the time horizon really comes into play. And corrections are necessary. They're healthy. You kind of have to wring out the risk and have things break down a little bit so that they don't build up into a lot. So I got to stick it to what are some other things in life? What are some other parallels to things that need to be broken down in order to be built back up?
Katie, we'll give Katie credit, even though she's not on the call right now. She brought up a good one earlier this morning. So when you're working out or when you're strength training, you kind of have to tear a muscle for it to build back and get stronger going forward. Hopefully not all the way tearing it where you're out for a long time, but when you're working out, everybody knows the sore feeling. You're tearing the little muscles and you're building it up to get stronger. Yep.
Even one that came to mind was even in forestry. You talk about having kind of the small fires that prevent the big fires. It just kind of takes a lot of that fuel out of the system sometimes. And then there's the sports analogies. Like, if we could just break up the Baltimore Orioles right now and start over, I'm sure it would be a little bit stronger than it's been. But teams do this all the time. It's the trust the process from the Sixers, and pick your favorite bottom dweller. They all kind of need to break down to build back up stronger. Yeah. So same's true in the stock market. So, we feel a little bit of volatility here. To the extent the market does correct even a little bit, it's usually a healthy development. And we're just kind of watching to see how the reopening trade and all the other trades kind of balance out as the economy continues to heal. So, all right, if you have any questions specific to your risk or what's happening in the markets, feel free to reach out to us. Otherwise, we will see you again on our next Intentional Wealth Update.